Welcome to Tuesday's Market SITREP here at Top Gun Options. Matthew Buckley, one of the portfolio managers here at TGO, and got some economic data out this morning on retail sales, core retail sales. And when you see core, it means X something. This was X autos. Big miss. And then complete retail sales, another big miss. And then import prices, actually not good as well. So obviously, apparently no harsh weather in April. We have a huge miss across the board with all the retail sales numbers. The weakness was led mainly by furniture and electronics, and that's the biggest miss, folks, back to 2010, the biggest miss since March of 2010. So very, very big numbers there, and it's the second biggest miss in over a year. So a lot of reasons for it, but let's just say that we're seeing a mixed bag of macroeconomic data, and we're also going to see some housing numbers and inflation numbers the rest of the week, along with University of Michigan consumer sentiment on Friday, and also some cap rate and industrial productions, and also the Philly Fed numbers coming out. NAHB, National Association of Home Builders, that's going to be another one as well. So we have a smattering, if that's a word, a smattering of numbers coming out this week. That's why we're kind of wallowing around here right now, folks. I mean, the Dow was up, it was down a little bit. We're flat on the S&P, just up a couple handles, up 3 points. But folks, technically, we are at historic highs. We went north of 1900 today on the S&P 500. Anybody remember back in January? The giant vampire squid known as Goldman Sachs predicted that the S&P 500 will end 2014 at 1900. Folks, it's May 13th. It's May 13th, and we're starting to hit, quote, some smart people's year-end targets on the S&P 500. So, I mean, hey, a picture's worth 1,000 words. Thanks, Mama Fed, for wiping our nose and patting us on the head for the past couple years. I mean, look at this. I'm no rocket surgeon, but there's a little bit of a trend there. No matter what the incident, a government shutdown, a nuclear Korea, Syria and gas, the Ukraine crisis, a Cyprus, you mentioned you can't drag this market down. But right now, at these precarious highs, I'm starting to feel it in my bones a little bit, so to speak, that we shouldn't be up here. However, I will be the first one to admit, just about every time I said we shouldn't be up here, we go higher. So I just knocked out a live trading session with our primary live trade brief traders, good 2-hour live trading session, where we're getting safe. One of the reasons we're getting safe is this. The VIX, folks, it traded underneath 12 the other day, okay? So let's just take a look at 3 months here. Look at this. We got below 12 the other day. This is absolutely nuts. The VIX at $12.13 is ridiculousness. It's redonkulous. Get Airborne on VIX. When vol is cheap, you buy it. When it's expensive, you sell it. It is absolutely cheap right now. And the best time to fix the roof is when it's sunny out, not when it's pouring rain, okay? It is very sunny out in the market, but I got to tell you, there are a lot of clouds on the horizon. Vol's cheap, you buy it. When it's expensive, you sell it. Something has happened every month in the past year to freak this market the hell out. Just look at that. Freak out, freak out, freak out, freak out, freak out. When vol's cheap, you buy it. And guess what? When it's expensive, you sell it. So we put on a bullish double vertical out to July on the VIX. And then if we do see a big spike in volatility and that trade makes some good scratch, we'll roll inverted and do a bearish double vertical. So when you look at the VIX, folks, it's not like looking at a chart of Apple. It goes from the bottom left to the upper right of the screen. It goes up. The VIX is like a heart rate. It freaks the hell out, and then it gets back to its resting heart rate. Right now, we're barely, we're below our resting heart rate here, and we are way too complacent for everything that's going on in the world, in my opinion. So, in my opinion, now is the best time to get long volatility. And we're going to talk about that with some webinars over the coming weeks here. So I would definitely be looking at getting long volatility here. Also, folks, if you're interested, we have a strategic partnership with the Black Bay Group. It's a registered investment advisor up in Illinois that have averaged for the past 4 years since inception their blended strategy a 22.5% return. And if you're interested in getting more information about them, you can shoot me an email, managedaccounts@topgunoptions.com. We also launched a hedge fund back in April with the same strategy. Obviously, that's just for accredited investors, and really can't give you any more information about that unless you reach out to us. But shoot us an email if you're interested in the registered investment advisor. The minimum investment is $30,000, and obviously for the hedge fund, we'd have to talk to you offline about that since it is a private offering. Okay, so I got to run, got to look at some weekly options trades, and take a look at this market as we just kind of teeter on the edge of greatness, and we're either going to be a hero or a zero in this market, and it's feeling in my knees that we might be closer to a zero. Okay, so I got to run. Happy hunting. Make sure you hedge. I'll be back with tomorrow's SITREP from beautiful Napa Valley, California. We'll see you.